Each generation of hoteliers faces a defining struggle. For some, it was starting anew and building a business and a life in a completely new country. For others, it was rebuilding their business after 9/11 and the 2008 financial crisis.
Now, young professional hoteliers and our entire industry are grappling with how the new coronavirus cratered our industry, seemingly overnight. The liquidity crisis gripping much of our industry is posing many questions and challenges for owners, especially those who are building their businesses when there is no business to be had. Our next panel is made up of young professional hoteliers, and they will be sharing their views on driving the future of the industry beyond COVID-19, how they are addressing this crisis, and what opportunities this downturn creates for the next generation of entrepreneurs.
Please welcome J.R. Patel, President and CEO of Helix Hospitality, Harshil Patel, Vice President of Champion Hotels, Raj Patel, Chief Development Officer of Hawkeye Hotels, Jatin Desai, Managing Principal and CFO at Peachtree Hotel Group, and our moderator, Teague Hunter, President and CEO of Hunter Hotel Advisors.
AAHOACON 2020, here we go, virtually, coming to you from our own houses. I'm Teague Hunter, Hunter Hotel Advisors, joined by an esteemed panelist, Jatin Desai, Peachtree Hotel Group, J.R. Patel, Helix Hospitality, Harshil Patel, Champion Hotel Group, and Raj Patel, Hawkeye. Hello, gentlemen. Thanks for joining me.
Hey, Teague.
Thanks, Teague.
Hey, thanks for having us.
Where is everybody today? Jatin, where are you?
I'm actually in my office today in Atlanta.
Oh, good for you. How often have you been going back?
Twice a week, Tuesdays and Thursdays.
All right. JR, how about you? Where are you?
Gloomy Chicago, in our office, actually.
Yeah, how's the weather? It is August.
Gloomy today. It's been sunny and beautiful, but I don't know. Today's just not our day.
That's all right. You can't have every day. It's Chicago. Harshil, where are you? Tell us where you are today.
Today I'm at home just because I needed a quiet place to be, but typically we're in the office every day. So.
All right. Raj, where are you? You got a fancy backdrop.
I'm in beautiful Des Moines, Iowa.
Are you sitting in one of your hotels right now? That's what it looks like.
Yeah, I'm sitting at the Hilton, actually, downtown Des Moines, but here in Des Moines working on the Hotel Fort Des Moines.
Oh, I love that. I'm going to dive into that later. That's a great project. All right, I'm going to get started. We'll go quick. Jatin, I'm picking on you, and we'll go down the aisle. Talk to me about the world today. Talk to me about the hotel investment world. Sorry, I'll frame it for everyone. Peachtree Hotel Group, you guys are a fund. You also have the equity side. You also have the debt placement with Stonehill Capital. You guys have been raising money over the last years. What is the investment world looking like today?
So our investor appetite is in this current market kind of, it's obviously shifted, right? So our investors have traditionally been high net worth individuals with not really the large institutions out there. The profile of our investors has not changed since we first started the company back in 2007. Our investors are always looking for risk-adjusted returns with capital appreciation, right? And obviously that's different today than it was 6 months ago. Since COVID began to spread across the country, you've got what was core and value add investing has really shifted now into a look at distressed investing. And obviously since COVID came here, spreads have widened, meaning that the cost of capital is more expensive. It costs more money for debt. Occupancies obviously for all of our hotels, and as you've seen in your respective properties, have plummeted. And then obviously the government's come in with their assistance that's allowed for us to have kind of a stepping stone as we kind of get through this. I think that our investors are looking to find opportunities with this level of distress, right? So in our view, and I think that, in some of those views, it's going to come in a couple stages, right? So if you look at previous cycles in the past, it's, maybe the note trade starts early and then you've got assets trading at the same time and all this other stuff. In this case, with the government stimulus that has come in and kind of how banks are reacting, it's very different, right? So you've got banks that gave forbearances and deferrals. So what you're seeing is you've got the discounted note trade is coming. It's come to some degree, but it's really come from the CLOs and these funds that have got to raise liquidity. You've got CMBS securities that are trading in the background, not the actual loan, but the securities that back those loans. And you've got kind of high yield leverage that's happening right now. So for deals that need capital, their only real source is going to a high yield or high leverage or high yield lender. Phase two is kind of going to be this process where you've got borrowers that have gone through the deferrals and are looking to recapitalize their deals. So that'll probably come in the form of maybe a preferred equity investment where a group like us or somebody else can come in and provide capital to allow for the property to continue operations or potentially to pay down debt. Kind of as that kind of comes about, but that's going to be after the government incentives and the such kind of go away and the deferrals go away. And then kind of phase three is going to be where you've got, and this is probably 12, 18 months from now, you've got kind of more traditional kind of assets trading fee simple where borrowers are saying, okay, or owners are saying, well, let's get out of this asset and kind of move on or raise capital for another deal and kind of just sell at market pricing. And that's probably not for some time now. So generally the stress is very large in the space. There's billions of dollars kind of being raised now to chase these opportunities. So I think like previous cycles, the volume is going to kind of ebb and flow, and it's going to come in stages.
All right, JR, I'm going to pick on you for a second. You bought, one of the smaller groups here, but a great story. And you guys bought 5-ish hotels from 2018 to today, mostly secondary, tertiary type markets. One, how your hotels doing? And two, how do you think that strategy will change in a post-COVID world?
Sure. The hotels are doing better. I think we definitely saw the bottom, and I would imagine most of us on here have. Improving, but I think July 4th weekend was a bit of an acid test for our properties, but our industry as a whole. So I think the number of cases rising nationwide, we're starting to see a bit of a plateau across our portfolio, and I think the industry is speaking that way as well. Post-COVID world, I think we're going to continue to see sort of flat performance, maybe moderate growth in it, but it's a different world. It's a different world, how we operate, how we transact. We keep hearing it over and over and over, unprecedented times, and it really is, we're rewriting the book.
Yeah, I think it's complicated. Harshil, talk from an operations standpoint. You guys own a bunch of hotels in a bunch of different markets, primary, secondary, tertiary, bunch of different chain scales. So what are you seeing out there?
So really on our end, we're seeing, we've had to obviously go in and just try to minimize all the costs you can. I mean, it's almost like luckily we have owner operators in most of our locations. So it's almost like running like a mom and pop again, where you're literally watching every single check being written, every invoice coming in. Obviously payroll is like your biggest, item that you can control. So we've had to really slim down all of our staffing and things like that. But in general, we're seeing extended stay properties they stayed pretty stable. Not obviously they did have drops in occupancy, but not as bad as all of our other types of like just regular limited service, select serve hotels. We've been noticing our interstate properties are performing better than say downtown properties. And I think it's just mostly people are driving instead of flying. So you get a lot of walk-ins, honestly. And then we're also seeing the Midwest got hit for us harder than say properties we have in Florida or states like that, where there's still some type of leisure demand. The Midwest is not necessarily a leisure demand market. So that's kind of where we're seeing things go. And then, our economy scale hotels and motels, like exterior corridor properties, even they're overall, maybe not from a revenue standpoint, but from a cash flow standpoint, with all of us having, most of our properties have deferred payments. So you can still get by on that walk-in traffic and people are very price conscious right now. So the lower end economy scale brands are still doing pretty decent. So
Raj, same question. What are you seeing across your breadth of your portfolio?
Sure. Yeah. When we shock test our portfolio, when we build and operate hotels, we shock test for 30% drop in revenue, and when overnight you have an 80 to 90% drop and the bottom falls out, even if you have done every single thing right, when that day comes, you can never be prepared for it. So we've seen that. We've seen our revenue go back up to about 50% in lieu of the 80 to 90% drop that we had. So that's where we're at right now.
All right. Yeah, it's tough to budget for an 80% drop in occupancy. JR, how's your portfolio operating at the moment? Yeah, a little bit, but can you tell a difference in asset class?
Absolutely. I think market by market, it's a bit all over the board, but asset class has been, and I echo what Harshil said, is our Southeast assets have performed a little bit better, a little more consistent, and the ones outside of the Midwest, extended stay, of course, has been consistent and recovered a little better. And on the economy side, definitely has consistently performed and been stronger. So much more price conscious consumer and much more location conscious consumer. So being sort of secondary market driven has been really helpful for us.
So how is this going to change your investment thesis going forward?
I think we're going to continue to look for what we have been good at. Secondary markets has been fantastic. We've never been a core CBD company, and big box. We like the smaller assets outside of the core CBD, and we're going to continue to do it.
How much? I want to stay with you. How much you go on offense, and how much you still have to be working on defense at the moment, trying to hold together what you bought the last couple of years?
I would say 75% offense, 25 defense is how I wake up. How I end the day, it's probably more 60-40, but we're cautiously optimistic.
All right, that's personality driven, I think. Jatin, talk to me about your existing portfolio and what do you see in nuances in the assets?
Yeah, so we have properties kind of across the spectrum, right? So various states and various kind of asset types. We do have some CBD, we have some secondary, tertiary, we've got beach locations. So we kind of get a few different subsets of the market. On the whole, if you look at our portfolio back in the first 2 weeks of April, we bottomed out at around 12%. We had one hotel that ran 1% occupancy for the entire month of April, but had a 50% increase for June. So it went to 1.5%. So you had some markets that really got hit very hard. And the polar opposite of that is you look at some of the Florida hotels that we have that are on the beach, and they're running, comparable numbers to last year and rates that are, anywhere from 10 to 15% higher than last year. So it's been really across the board. What we are seeing is that, the per occupied room cost for labor has really come down quite a bit. I think as Harshil mentioned, that you really got to control, we've been able to control those costs pretty dramatically kind of at the properties. And what's happened is you look at kind of run rate per occupied room in 2019, you were probably around $22, $23 per occupied room for labor. You're running probably around 10 or 11 bucks today in the current environment. So even with occupancies coming back, you're still able to cut that labor cost pretty dramatically. So our teams at the properties are doing more with less people. And I think that's probably a sign of kind of what's to come as we progress through this cycle.
Are you having trouble getting people back, getting workers back as occupancy builds?
Yeah, I mean, I think that, in most markets, you've got people that have been, hey, I'm not coming back just blatantly because they're getting the unemployment credits. And you got some others that are just like, waiting to see kind of what happens, or saying that, they don't feel safe, or whatever the case is, even though we've made every measure to make it as safe as possible. But there is that risk, and it's understandable. So it has been very difficult to get people to come back and actually want to do the jobs that they were once doing before.
I saw 3 heads nodding. JR, you guys struggling with that as well?
Yeah, absolutely. I mean, that's a consistent struggle across the board, market by market for us.
Yeah. Harshil, same with you?
Yeah, same thing. I mean, yeah, it's like just like Jatin said. I mean, when you have the unemployment bonus, because in Oklahoma, for example, $600 extra a week, which, I mean, I know it's ended now, but that's a lot. I mean, that's making way more money than they were making before. So technically, why would they want to come back to work? And then obviously with occupancies for us here, especially in Midwest, during the week we're not seeing any business travel, and then on weekends we're getting slammed because people that have the unemployment bonus and things like that, they're staying in the hotels, and so they're filling them up. But it's so hard to staff because a general housekeeper, I mean, they need stable pay, and if there's days during the week where you can't call them because you don't have rooms rented, but then you're trying to get them all in on weekends, it's just not stable for them, and so we can't blame them for wanting to go somewhere else and do other types of jobs. So
I get it. Raj, let's go a little dark. Talk about how much, what kind of bank issues you're having. We're talking cash flow and liquidity issues. And really, probably my question is, what are your banks working with you? You guys are a heavy relationship. I get that. What kind of banks, what kind of loans do you have? CMBS, do you have any versus SBA versus balance sheet? And are your lenders working with you?
Yeah, it's we're lucky that we have a lot of relationship-based banks, and right now has been a time where we've had to lean on our banks and our lending partners more than we ever have before in the past. So we were making those calls daily to our lenders and just giving them the updates, showing them what we're seeing in real time. And they were very receptive. We had banks calling us up front to ask us, what can we do to help you? What can we do to be there for you to get through this time? So it's been difficult, but right now the lending environment, has completely changed, as Jatin was talking about. We have almost all traditional permanent financing, but we have had to look at PACE lending. We've had to look at SBA, and we are looking at those forms of lending now. With our background in our company, we have been able to still secure new financing for projects and still move forward on projects that are currently underway. If projects are, not underway, banks certainly are hesitant to look at anything that, is has not broken ground yet.
All right, let's stay here, Raj, because you're the developer of the group. How many projects you got under construction right now?
North of a dozen under construction, with another 10 behind that.
Yeah, sure. Why stop? Don't slow down. So what's happening? What are you seeing in construction? Are you labor? Are you seeing any labor issues with construction? How about financing? How about cost materials? Is it coming down? Is it going to be a better time to develop instead of worse? What are your thoughts?
Great question. Up through now, we've thought that we've done everything right to prepare ourselves for any storm that was coming our way. We were building properties in great markets, great brands, great locations. We were doing our proper due diligence and felt great about our development pipeline. Overnight, we are now building hotels at peak pricing in the trough of the market. So that's not a good place to be in. And any project that's underway, anything that we've broken ground, it's a freight train. You can't stop it. So we're committed to moving forward on any project that's underway. And we've been able to do that. We had a few projects that we just closed our loans on, and those dozen are all underway. And we are minimizing cost and cutting costs right now on those. Any project that is not underway and is in the planning phases, we are certainly looking at the timing of it and when do we start that project. We're not planning to break ground on any new projects in 2020, and most likely all the way through second and third quarter of 2021. Once we can start seeing that recovery, once lending comes back around in a strong way, and once we can feel 100% confident and comfortable with moving forward on those projects. We don't have any plans to scrap any of those projects, but just waiting for the right timing and how do we maximize value and cost. In terms of cost, I do feel that cost will come down. Right now, they're still stable. We haven't seen costs coming down, mostly due to the backlog of construction activity. that's still going forward. There's a lot of public work going on. There's a lot of private work, and that's active. So once that slows down, we do think that there will be a decrease in cost.
Yeah, I think I would agree with you. Although I would like to think you could renegotiate a couple of your contracts right now, but whatever. Harshil, opposite. How much do you have under development right now?
So currently we have 0 under development. I mean, there was things in design phase and things like that, but nothing actually, shovels in the dirt kind of deal. So we lucked out on that side of things. It just worked out for us on that thing. That was just luck. So other than that, we're kind of looking at the same thing as Raj. I mean, we're not looking to start construction on anything for at least another 12 months to 14 months. And it's really hard because right now, with occupancies where they are, ADRs have dropped in a lot of markets. And to recover the ADR, even if your occupancies pick up, it's going to be really difficult to have ADRs rising or going up at the same rate as occupancy. So it's just a guessing game, and then it's a waiting game, honestly, right now. So we're kind of on the same page as Raj. We're just going to wait things out. Nothing in 2020, probably nothing in most of 2021. We'll probably look at projects probably earlier 2022 is what we're looking at.
All right. JR, you guys don't develop. I'm assuming you're just sitting back waiting for the distress, see what falls in your lap, right?
Absolutely. We do a lot of big, deep turnarounds, deep renovations, and it's actually been a bit opposite for us. We've been able to capitalize on the uncertainty of ground up and have a lot of GCs speed up and subs speed up. So that's been helpful for us. So I think we'll be well positioned Q1 into Q2 2021 to be able to start, hopefully starting to see a bit of a ramp up on some of these projects. So a little bit longer on the business plan, but I think we'll be positioned well time-wise.
Jatin, you guys actually do some development. Do you have anything in the pipeline right now?
Yeah, so we've got 13 deals that are actually in the ground or coming out of the ground, and about 10 that we have put on pause. And that pause kind of, as Raj mentioned, we're kind of waiting for pricing to reset to some degree. The few that we did start, we started one a few weeks ago, and that was one that we were able to get some reduced pricing on. The contractors were getting a little more aggressive with their bid, considering their workload and such. So we saw about a 5 to 7% savings in that one compared to what we were pricing in January. So you see some savings in some markets, and others you're not seeing really any at all yet. So I think that we're the ones that we're moving down the line on. Our lenders are still there with us. Some we're building just through cash. So we're just getting those open, and we think that coming out of this, and if we start today, we open 18 months from now, the market is going to be a very different place. And so we think that having a new property in a good market, you could benefit from that. So we are still pursuing our developments, but not really the 10 or so that we've kind of got in the back burner that are still active but waiting. So.
Yeah, it makes sense to me. I can have a thesis of where it'd be great to open something, I don't know, 24 months from now, open in 23 kind of thing. And, the time with Raj, I don't know how you put the brakes on these things. They're a freight train moving. I don't know how you stop a development project. So kudos for you. Jatin, talk to me about the debt side. So we'll keep diving into the money, but one, what kind of lending are you guys doing on the Stonehill side? Are you doing construction financing, and what kind of problems are you seeing, and what are you offering to your borrowers?
Yeah, so I think that as the guys have mentioned on the call, conventional lending is pretty much on pause right now.
Right.
Relationship banks, even as good as your relationships might be, deposits are very important, and even those are not getting enough attention to actually get transactions done. I think that from a general perspective, if you look at banks today, if the bank that you're dealing with is still doing deferrals or forbearances on existing hotel credits, they're not going to go out there and originate a new hotel credit. It's counterintuitive to how the bank's going to actually operate. So if you look at kind of what we're doing on the finance side, it's kind of, as Raj mentioned earlier, you're looking at kind of alternative ways to find financing capital, and that can come in the form of new markets, historics, PACE loans, SBA, non-traditional lenders. If the government and banks kind of figure out how this Main Street lending platform or program is going to work, that could be an avenue for hotels. It's really not one right now, the way it's structured, just because of the rules and everything around it doesn't really help anybody listening to this call. But if you look at on the Stonehill side, we are looking at some construction financing, but very, very selectively. It'd have to be an amazing deal to actually work, and pricing obviously today is much higher than it was previously. And that's not just the non-traditional lenders like us, but it's really looking at even the commercial and more regional conventional banks that are their spreads overnight increased by 300 to 400 basis points. So that's kind of trickled all the way up the line.
Can you give us, as much as you're willing to disclose, some specifics on the deal Stonehill closed last week?
So we closed the financing in Virginia where it was a refinance. So refinances are obviously a little easier than a ground up construction deal. This deal was one where the basis was relatively low. When I say relatively low, much lower than the LTV was much lower than kind of a typical transaction. And it was a great location in a solid market. And it's probably all I can say about that deal publicly, but it was one where it was a very safe transaction that allowed for the borrower to get his CMBS loan refinanced and allowed us to put capital out at a pretty safe basis in today's market.
I don't think you answered my question, but I'll let you off. So what we're seeing today is just echoing. We're seeing, debt funds like you guys that are lending, that are making up numbers. I mean, I want to ask somebody about appraisals and how are these things appraising, but Jatin, you guys don't use appraisals. You're just out there lending, and we're hearing L plus 700-ish, plus or minus in a lot of cases. That's a pretty wide spread. JR is nodding his head. And on the other hand is SBA. If you got to get a loan to SBA has been very attractive, except that we were all kind of mad at SBA for a long time. Now we love them again. CMBS is dead. I don't think it's coming back. And I know it's relationship lenders, but the relationship lenders aren't lending because they're scared, I think is my answer. So they're not lending. So I think it's tricky out there. JR, you were nodding. So what are you finding out there on the debt side?
The relationships are they're great, but they're not getting us anywhere. I would have to echo you. It's SBA, which I think we all put to the side for a while, but it's SBA and it's the debt funds. There's also a handful of creative groups out there that are doing participating debt, and just I think the oddballs are now coming to light, but the conventional is gone. CMBS is gone, at least for the foreseeable future.
Harshil, where are we headed from here?
Honestly, I don't think anybody has any clue. I mean, we're all hoping for the best. We're hoping occupancies keep rising, and this virus with the fall coming up. I mean, everyone keeps talking about another wave and things like that. So, from our standpoint, we're just trying to hold on till next year, middle to end of next year. Hopefully, things are improved enough by then. I mean, in the meantime, we're still looking at like for assets that are distressed and things like that. That is one thing we've noticed with the banks lately is that they're not interested in loaning on anything that's new construction. But if you can get a distressed asset at a low enough basis, they are interested in that. And that mostly goes to kind of what JR and Raj and Jatin, everyone was talking about, is that if you have the relationships with them and they trust you enough, I think if they see a value add deal that makes total sense, they're still willing to kind of loan on those types of deals, but not really for us, not new construction. They're pretty hesitant. So
Raj, what's your vision for the future? What are we going to look like in a year? Yeah, it is bleak. I agree. Let's keep going.
It's bleak. The COVID aside, there was already the saturation issue. There was the oversupply issue. There was the too many brands coming out issue. Overabundance of operators and developers. Overabundance of cheap capital. So when you pair all that together, we were already headed in a downhill slope, and then you tack COVID on top of it. The future is bleak. On the bright side of that, there's no country in the world that's more resilient than the United States. And even our industry hospitality, lodging and restaurants, it's a very resilient industry. So certainly it will come back. The time that's going to take to come back is what's unknown. What I feel good about is that the operators and developers who are meant to stay in this industry, they will grow stronger from this. They will strengthen. They will pick up, habits that'll stick with them for a very long time. Especially, all of us here on this call, most second generation. We have our first generation to lean on and ask questions. They've never gone through something like this either. But for us to go through it at this age, with decades and decades more of exposure in this industry, I feel good about implementing, what this is going to do to us long term. So that's my vision for the future. Is I think we'll grow out of it stronger. The industry is resilient, and it's going to be tough the next few years.
I think that's really well said, Raj. And I think we should listen to our parents and their words of wisdom and take it to heart in these troubling times, because they've all been there before, right? I'd love to say, let's all go be young and naive and do something stupid right now, but that's probably not the right advice. JR, who are going to be the big winners and losers coming out of this?
I think a lot of the second generation folks who are in the industry. Good capital reserves, not heavily levered, who are patient, who were prudent, and frankly, who are willing to fight it out. I think this is a contest of who can hold their breath the longest. And I think we've got 18, 24 really tough months ahead. But those who are opportunistic, well-funded, well-capitalized, I think are going to come out of it even stronger.
And you got time on your hands, right?
Yeah, absolutely.
Yeah. All right. Jatin, you're ending us. Final statements. Give us some wonderful words of wisdom to leave us with.
So I think the one thing that I'll say is that, there is an end date to all this, right? I mean, when and if a vaccine comes out that's effective and efficient, travel will come back. The leisure population, the leisure travelers already proven that they're willing to come back in the markets that are leisure. Now what we need is corporate. So once corporate and conventions come back, that's going to follow the vaccine. Look at the news. There's vaccines that are being produced that are, who knows how effective they're going to be, but there will be one eventually. So there is going to be an end date to all this. So I'll leave it at that. I think, Raj, you're right. The future is going to be relatively bleak for the short term, but there is an ending.
No, I'm going to pretend that didn't happen. Gentlemen, thank you very much. We appreciate it. Big thanks to AAHOA and Rachel and Abigail and Akshar. You guys do a great job. Everybody stay safe. Everybody stay healthy. And everybody stick together, and we'll get out of this. Thanks, everybody.
Thank you.
Thank you.
Take care, guys. Thanks, T.